Hi, Peter here from How to Invest HQ, and in this month's edition of the Best Stocks to Buy, we're going to be talking about four great stocks with recent pullbacks that you can pick up in April of 2014. There's going to be a quick format change, and before I just said, these are all great stocks to buy. They pulled back in price, they're good to get into, but that's all that was really said. Now we're going to break it down into long-term and short-term buys. And let me clarify what that means exactly. So a long-term buy typically represents a growth stock that has pulled back in value and that I believe makes a good investment. The only thing is that with growth stocks, I believe that they'll be worth much more several years into the future. They might not necessarily be worth more next month. So you have to hold on to these for several years to see great results, and you may need to be patient, or you definitely need to be patient, and you may need to average down or continue to buy as the stock drops if you're going to maximize your return. Um, and once these growth stocks have negative momentum, I'm calling them out and saying, hey, this stock's dropped a lot in price. It's a good company. If it used to be worth more, and I think it's going to be even more valuable in the future, then, once the stock is valued like it was before, in accordance with its new growth, it will become more valuable. But sometimes, if a market's not behind a certain stock, even if the company is doing very well, its stock can continue to trade downwards. So we're breaking these down into long-term plays and short-term plays. And that's even play is not the right word. All of these are long-term plays, but all of these are long-term plays. But long-term stocks might take a while to catch up to really provide a return, whereas short-term buys represent companies that have pulled back, but they're going to be more resistant to momentum changes and huge swings just because they already have big earnings power or they pay a steady dividend. I'm not saying these stocks are a quick flip. I'm just saying that they're more likely to pay off in the short term. An example of this is a company like last month, I suggested PepsiCo. They had pulled back in price a bit and they went up about 2% over the course of the month. It's not worth buying that and selling it a month later for the 2% gain. It's not a quick flip. I'm just saying that this is a solid company. It's, worth buying at this price. It's a little bit cheaper than it would be normally. So if you like this company, if you've been wanting to invest in it, and if you like the stock, then this is a good chance. And I still think these companies are going to be more valuable in 3 years, but there's just going to be less fluctuation in price. But the reduced downside results in reduced upside. If a stock like Pepsi, yeah, it's not going to dip in a month like March where growth stocks got killed, but it's also not going to double up for next year. These stocks are more likely to produce a steady return. It's a good place to enter, but they're not going to make you $1 million either, unless you have, $20 million to invest, then sure. So, growth stocks, to a little preface, they took really heavy losses in March and even into the first week of April. And that's okay because these stocks really need to let off steam. I mean, they were trading way too high at the end of 2013. I really like investing in growth stocks, and I've been doing this feature, the How to Invest HQ portfolio, where I've been steadily investing into stocks, and it's been really hard to put money into stocks just because all the companies I like are trading much higher historically, are trading at much higher price to earnings ratios compared to their historic values. And that's just because there's a ton of momentum behind growth stocks, and now it's just, it's pulling back, and it should. And I expect that this might continue. They're still somewhat expensive, even after their losses, say to this time last year. We had such an incredible run up in the last half of 2013 that even with this big pullback in March, we're still above where we were, in April 2013, significantly. So we might still see some more contraction, and that's fine. Just don't, if you're steadily investing over time, just as these companies move down in price, you just continue to plug away, continue to put in money. And so here's a long-term play. Amazon could easily drop in the next month, but right now it's down a lot, and it's a good entry point. And I think that, a couple years from now, Amazon's going to be worth much more. And the reason this is such a good entry point is we're down 19% year to date and down a whopping 26% off the 52-week high. And nothing's wrong with Amazon. It's just it went up, 60% last year, and it's growing at 15 to 20% a year. That's its revenue growth, if even 15%. I mean, maybe it's 10%. Double-digit revenue growth They're looking like they're slowing down a bit, but that's just because their revenues are getting up there. You can only grow revenue so fast once you're pulling in $70 billion in revenue. And I really like Amazon. They're a great company with great leadership and good growth opportunities. And the thing that I really like about Amazon is they really have no work to do in terms of building their business. The business is already there, and there's this secular trend of where people are doing more things online. And when people buy more stuff online, Amazon benefits because they're the major player in this space. No one comes close in e-commerce, not business to consumer e-commerce anyway. So Amazon just has to show up and keep doing what it's doing, and it's going to massively grow revenues every year. So anything extra that it comes up with to do is just a bonus. And as I said, even though Amazon is down so much, it's still up 21% year over year. And as mentioned earlier, its revenue is not growing at 21%. It's about 15%. So there's still room, and a stock like Amazon trades on revenue. So if revenue growth is 15%, this is very rough math. But every year, as long as Amazon keeps up that rate of earnings growth and the actual amount of earnings growth, the stock should be gaining about 15% a year. As that earnings growth slows down, so will that ratio won't necessarily hold. If earnings growth is slowing, then its revenue won't be valued as much and it could drop more. But the point is that the stock's up 21% a year-over-year basis. It really only deserved to increase by about 15%. There's still a little bit of room for a drop, but I believe that over time it'll be more valuable. Just be prepared to keep averaging down if it continues to dip. What is certain is that it's a much better buy than it was at the start of the year when it was 20% higher. And just as a preface, I am looking to get into Amazon. I will be purchasing this for the How to Invest HQ portfolio around May 1st as next month's purchase if it stays at this price point. Hopefully it holds for me for a little bit longer or even dips down lower. That would be great. LinkedIn, this is another How to Invest HQ portfolio stock. It's long term. It took a huge beating on Friday, and I recommended this last month. I've loved this stock for a while. I thought even at $200 it was a good buy. So the fact that it's $165 after the huge loss on Friday is wonderful. And really, LinkedIn is not that expensive. You can't look at the price to earnings ratio for LinkedIn because LinkedIn is a growth stock. It's growing revenue at 30-40% a year, and it's a tech stock. It doesn't have much fixed expenses, but it's spending money right now on sales staff. They've specifically said we are putting all excess revenue into sales staff. And LinkedIn doesn't really have proprietary technology. What makes LinkedIn powerful is its network and the fact that people are hiring off of LinkedIn. So sales staff is almost like research and development for LinkedIn. It's investing in when they invest in sales staff and they get more businesses to hire people off of LinkedIn and they get more members to be premium members. That's investing in their company because the more people that are hiring off of LinkedIn, the more the more customers per se or regular people that are going to sign up for LinkedIn to try to get a job. So when LinkedIn uses money on sales staff for more, to get more people to use their hiring solutions, platform, that makes the LinkedIn much more valuable for its users. So that's how they improve their network is with sales staff, and I think that's a very smart play. So with that in mind, really LinkedIn should be trading on revenue or price to revenue ratio. That's how growth stocks like this trade that are spending all their money. And, it's kind of a function of revenue growth, just like PE is a function of earnings growth, where, the more growth there is, the higher the value it can sustain. But let's compare it to some other companies in the space. LinkedIn currently is at, for its 2014 projected earnings, or revenue, that should say revenue, not earnings, they're at about 10, and I think their earnings are pretty conservative. I think it's actually going to be closer to 9. So for every $9 of share price, there's $1 of revenue. And compare that to other stocks in this space that are very similar. Twitter is over 20. Twitter has significantly less revenue than LinkedIn and has a higher market cap. And that's just not right. And Twitter's let off a lot of steam too, but it's like LinkedIn's getting taken down with it, and it just doesn't deserve to be. And I think once we see another earnings report or two, this trend is going to, shift. But it could drop lower. So I mean, I've added more. I recently averaged down here, and I'm prepared to keep doing so. Um, and I think it's a good opportunity. So Starbucks, this is what I would call short term. This is more likely to pay off sooner than later, as opposed to LinkedIn and Amazon. And I recommended them last month, and they jumped in price, about 5% from when I made the recommendation during the middle of the month. But in this slide in the end of March, they kind of fell right back down to this month's starting, or March's starting price. And they were down 0.15%. So they're practically even over the course of March. Um, and I actually bought into this stock on Thursday in a personal position. It's nothing to do with the portfolio, just my own money. I'm investing in Starbucks, so I am putting my money where my mouth is on this. And I like Starbucks. My favorite thing about Starbucks is they're very well run. I really like their CEO. He knows what he's doing, and they have a good product. So those are like the two things. If you have something good that you can sell, and someone that knows how to sell it, and use it intelligently, that's that is why they are still growing quickly despite their size. So they definitely have room to grow massively. And I also like them because they still have room for international expansion. And Starbucks has over 20,000 locations now, and a massive 13,000 are in the United States. They're little tiny shops, so they can build them everywhere and barely pay rent. Because their space is so small, and they're good for foot traffic for other businesses. So little shopping centers love having a Starbucks in them. Um, 13,000 out of 2,000. Starbucks is just getting started in China. They have like 800 or 900 stores there, which is now actually their second largest market. It's right about the same as Canada. But I mean, China has a lot of people, and it's a very strong emphasis on working culture. And whenever there's environments like that, there is always room for coffee, especially premium coffee. And just to think of like a New York City as an example like that, there's so many Starbucks, and that's an area where people work a lot of hours compared to the rest of the country. So another good short-term investment, or not short-term investment, just a short-term good buy, we'll say. I might have to change that. That sounds like I'm saying to buy and then plan to flip it. But anyway, there's little downside to holding Apple at its current levels, but just because of its buybacks, its revenues, its balance sheet, its earnings, and its dividend, it just really can't drop any lower. I mean, Apple is at like the bottom. And just to give you an idea, that Apple's price to earnings ratio is 13.19 as of today, and Microsoft's is 14.72. And that's the sickening that Microsoft can be worth more than Apple on a dollar for earnings, you know, on a price to earnings ratio where a dollar of earnings from Microsoft is worth more than Apple. That makes no sense. Apple's got a better balance sheet. Microsoft has a good balance sheet too, but Apple just has a larger cash pile. Um, and when I think about the future, it's like I don't understand how Microsoft lives, much longer. I mean, they're going to continue on, but where do they go from here? Like, how can they have a 14.7 price to earnings ratio? Their major product is still Windows, which is not doing very well because tablets are starting to replace PCs and laptops. There's still a place for laptops and PCs, don't get me wrong, but it's mostly the laptop that's suffering to the tablet, and there's still, workstations that people are using, but that are running Windows. It's just that, that's not growth, though. There's no growth in Windows core areas. And they actually had to recently release the Office Suite for iPad. And I think that they should have done that because they just didn't have any other option. People were buying iPads, and that's their other major source of revenue is the their Office Suite. So it's like, where are they going with revenue? And I guess their other major revenue generator is Xbox, and Xbox One is not going well, and I also just don't think it's a good business to be in. The reason I say that is because developing console games is getting way too expensive, and I feel like console games used to be really subsidized by the casual player, and a lot of casual players are, the next generation gaming device for them is the iPad. People are playing games on their tablets. They're not playing games on their console. Like when I look at kids in the 7 to 10 range, and most of them play on an iPad. They don't have consoles. They play on their iPads or their parents' hand-me-down phone. Like that's what the kids always ask for. They want the phone. They always are bugging their parents to let them play on their phone. I know my sister's kids have an old iPhone that they disabled for service. They download a couple games on it and let the kids play on that. That's their Xbox. So point is, Apple is very poorly valued. Microsoft, the company with little future, is they have the ability to continue to generate revenue. They just don't have the ability to grow earnings. They're just going to be kind of a static company. They're getting more for their dollar than Apple. So it's like the investors are saying, well, Apple's actually not even going to be steady with its money. It's going to lose. It's going to continue to lose earnings. Which as it's growing revenue, it really hasn't proven that it can lose earnings, especially given the fact that they're buying back shares. If anything, earnings per share are slowly going to increase as they continue to buy back shares. And Apple should hike the dividend very shortly, and when they do, it will be comparable to Microsoft. So Microsoft is not going to have that advantage for very long. Um, if you follow this at all, if you follow my blog, you know that I added shares to personal positions in Apple back in February in the mid 520s. So Apple's a little bit higher than that now, but not by much after this recent, March decline. It was up in the 540s, but now it's back to 531. And I'll be looking to buy more of this soon if the stock stays under, 535. I do think we're going to get a dividend hike at the end of the month, and I am happy to be paid to wait because I believe that Apple will just continue to provide this steady return outside, even with no new product announcements. And that's really the upside holding Apple is that if there is a new product line, we could see some price to earnings expansion, at which point, you can make a strong return. And just a quick update on March's picks. Many stocks don't change significantly on a month-to-month basis. And if we're picking negative momentum stocks, which I am doing in these series, I'm picking out stocks that I think are good companies that have pulled back. A lot of these will continue to slide for a few months before making a turnaround. So I wanted to revisit last month's picks. Actually, Starbucks and LinkedIn were included last month. Starbucks is around the same price, and LinkedIn is even cheaper. So I actually discuss those again. I actually bought both of these stocks over the course of the last month. I bought LinkedIn very recently, and I just bought Starbucks 2 days ago. So I'm putting my money where my mouth is on these. I really think that these are good buys. Just a quick update on two of last month's picks. One is Costco. They're down 3.5% from the time of recommendation. This is the one pick that I'm actually going to take a step back from. I still like the company, but I'm looking at their balance sheet and I'm re-evaluating, the company, and I just think that they actually might continue to trend lower. And their price to earnings ratio is just a little too high. It's up at 24, and I'm looking at their earnings growth and just some of the sales figures I've been looking at. They just don't look like they're going to continue to grow at the pace that they did in 2011, 2012. They're still going to grow, but by 6 or 7% a year instead of 10 or 11% a year. And if that growth rate stays in half, which I think it will, then the price to earnings ratio is going to pull back. They need to contract more, so I think we wait for that contraction to happen and then buy in. I still think it's a great company, great long-term stock, just not right now. But one that did do on a more positive note, PepsiCo, up around 2% from the time of recommendation, which is a really big move for a company like this. And they're a blue chip dividend stock. And they paid out a 0.7% dividend during that time as well. So it's a solid return for a month. I still think they make good for a good long-term investment. Maybe, they're not quite as appealing as they were last month. A couple percentage point shift is pretty big. In a stock like this, you might get 8 or 9% a year gain total, including the dividend, in rolling the dividend back into the stock. So when you get, almost 3% of that in a month, you're not expecting much more move for the rest of the year. That's several months worth of return. So, it's still a good buy. Not quite as attractive as last month, but I would still definitely go ahead and recommend it. And that's about it for this month. Again, I'm keeping an eye on Amazon. That's my plan. I really want to get in, especially if it can continue to drop. So, hope this video was helpful for you. Go ahead and subscribe. And next month, I'll be putting out another update on both my public portfolio and the best stocks to buy for May.